Hey guys, how's it going? Today I'm going to do a video on what is a bond. Okay, so basically we talked about before in one of my previous videos what a stock is. So basically how I explained it in the video is when a company needs to raise funds, what they can do is they can issue shares on the open market, or they could become a public corporation. Now, if you have a public corporation or even not a public corporation, governments use these, cities use these, different types of entities. They can also issue bonds. So the simplest way that I can explain this to you is, let's use a company, for example. Let's say Tesla, because I've been talking about Tesla lately, and I've given examples of this. So say Tesla needs $2 billion. Now, it's pretty tough to get that kind of money unless you're going to be issuing equity, like we said, shares in the company, or debt. You can either tap, as they say, the equity markets, or tap the debt markets. So the debt would be bonds. So what they could do is they could sell those $2 billion worth of bonds. So what that means is investors will give them $2 billion. Now, in return for that, those investors expect a return on that money. So generally speaking, these bonds are typically set at par, which means is they are usually at $100 or $1,000 face value per bond. Now, these bonds usually pay semi-annually, so this is twice a year, a coupon. And the coupon basically is the percentages. So you could be 6%, 10%, whatever. Different type of percentages you can get. And that's what it's called, is coupon, the coupon payment that comes in. Now, when the maturity comes of the bond, and the maturity meaning the end of it, it could be a 10-year bond, a 20-year bond, whatever, right? Then that money must be paid back to investors. So to recap here, the investor gives them money. Say I give them $1,000, and now I expect 3% on that per year until maturity, and say 10 years, and then I want my $1,000 back. So that's how it works. Obviously, these can get a little bit more complex. A lot of this depends on when we look at the price of the bond, it depends on, and the coupon more specifically, I should say here, it depends on the credit quality of the issuer and the length of time until it expires, and also the general interest rate at the time. So when I talk about the credit quality of the issuer, there's bond rating agencies that actually rate these bonds. So as you can see, there's quite a few here. Moody's, S&P, we're talking about the States here, and Fitch. So they can be AAA and everything way down to C to D's, right? And generally speaking, the higher grade the bond, the less coupon it's going to pay. Coupon being percentage here again, because there's less risk that they're going to default. There's less risk that this company, or government for that matter, is going to not be able to pay it back, right? So that's what these rating agencies are, and this is what these ratings are. So if you have a very, like I said, a very low quality company that needs money, they're going to have to pay a higher coupon, because there's a good chance that when the maturity comes that I'm talking about, that they won't be able to pay it back. So again, I talked about the typical issuers here. One of the biggest ones in the States here is the U.S. government, right? So these are what have I got here? These are treasury notes, and as you can see here, well, I should maybe explain a little bit first here. They're a debt security, and usually these are with 10 years or more, and they make payments semi-annually, right? So there's different kinds of these, of course, but they're generally considered risk-free, because the government can always just print more money, and that's why they're generally very low. Now, there's one kind of interesting characteristic. Usually these are based, like I said, on the face value, which is 100 or 1,000. Here they've got 100. So without understanding too much, because actually bond calculations and stuff can get quite complex, you can actually see that the price, well, we have a bid ask here, will go down, or it'll be higher than 100. Now, this all depends on when these bonds were issued, what happens with interest rates. Now, that might not be intuitive right now, but think of it. Say they give a whatever. It doesn't matter what the percentage coupon that they give. Now interest rates rise. It is now not as valuable, right? Because now they could just put their money in the bank and get money from the bank or whatever type of investment this investor wants to make. So therefore, these are not as valuable. So without getting into too much detail here, the price will drop, right? Versus in another case here, when we see, again, there's different factors that come into play here, but I'm just saying everything remaining equal, this is how bond prices drop or fall. In this case, interest rates might have actually went down, right? So now this is slightly more valuable, right? So, and then one other thing I have here is I have just an example here really quickly, just to give you some context. So there's governments and cities and whatnot that issue bonds when they need money. And there's also corporations. I've talked about this before. Tesla, not too long ago here, did 1.5 billion. I've seen this quoted a couple different times. 1.5 billion in order to fund their Model 3 production, and these are actually underwater as we speak because of different issues, concerns. And here, this is what we're talking about right here. I wanted to show you. They were assigned a B-, and this brings them into junk credit territory. And this means that they pay a pretty high coupon as well, right? Because there's not a lot of faith that they might be able to pay back that money when they mature. And I believe they have pretty long maturity on these. I'm not sure if it says here. But the one thing about bonds, and I've never really got into bonds too much, is they're very difficult to find quotes on. Like, it's easy to go onto Google Finance or whatever and to find a stock and a quote, but these aren't generally published on the web too much. If you have a brokerage, you can look into them, and there's some resources, but it's not really easy to find this, right? So that's kind of one reason I've stayed away from them. And it's just basically, giving a company debt. Just a couple little other things here. I wanted to mention that there's different types of bonds as well. There's, zero coupon bonds, and basically what that is what the name is. They give you zero coupon, but what they do is they'll sell them at a discount, and then basically when the face value comes on maturity, that's how you make your money, right? Because they're selling them at a discount, and that's basically how you make your money, right? There's also convertible bonds. These are embedded with call options. And maybe I'll do a video on that in the future, but don't worry about that. But that basically allows them to convert the debt into equity, meaning shares in the company. And again, if you need to know more about that, go back and watch my video on what is a stock. So you could basically convert that debt into a share in the company. And there's also bonds that are callable. We won't get into this too much, but basically the issuer, like the corporation or the government, well, the government would never do one of these, but the corporation can call back the bonds from debt holders if interest rates drop significantly. And also there's puttable ones in which the creditors can put the bond back to the issuer if the interest rates do not rise sufficiently. So as you can see, they can get a little bit complicated. But the basic thing to take away from this is what is a bond. And I thought it'd be kind of beneficial for you guys to get a video on this, because I've talked about this before, and I realized that I never really explained what a bond was. I wanted to keep it pretty basic. And in regards to U.S. Treasury quotes, there's also ones all over the world. In Canada, they're T-bills, same sort of thing, right? And generally speaking, they pay a very, very small amount because they're backed by a government, and they're essentially considered no risk. Anyway, I think that's a quick explanation as to what a bond is. If you guys have any questions or any concerns with this, leave me a comment down below. Don't forget to subscribe and hit that notification button so you know when I release a new video. Anyway, I will see you guys in the next one, and have a great day.